I'm going to tell you something that might make you uncomfortable. Right now, while you're listening to this, millions of investors are panicking. They're watching their portfolios decline. They're reading headlines about recession, about market crashes, about economic disaster. They're scared and they're selling. They're liquidating positions at exactly the wrong time. They're locking in losses. They're guaranteeing that they'll miss the recovery. And I'm doing the exact opposite. I'm buying aggressively. I'm deploying capital into opportunities that only appear when everyone else is running for the exits. And today I'm going to tell you exactly what I'm buying, why I'm buying it, and how you can benefit from the same strategy that's made me billions of dollars over 8 decades of investing. But more importantly, I'm going to teach you how to think about market panics so that the next time everyone is selling in fear, you'll have the courage and conviction to buy. Let me start by taking you back to a moment that defined my entire investment philosophy. It was October of 1987, Black Monday. The stock market crashed 22% in a single day, 22%. The largest one-day percentage decline in stock market history. People were terrified. They thought the financial system was collapsing. They thought another Great Depression was starting. And they sold frantically, desperately, at any price. I was running Berkshire Hathaway at the time. We had substantial cash. And I knew that this panic was creating once-in-a-generation opportunities. So while everyone else was selling, I was buying. I bought Coca-Cola stock. I bought other businesses at prices that made no sense. And over the next few years, those investments generated extraordinary returns. Not because I was smarter than everyone else, not because I could predict the future, but because I understood something that most investors never learn. Market panics create the best buying opportunities, always have, always will. When fear dominates the market, when everyone is focused on what could go wrong, when selling pressure overwhelms rational analysis, that's when truly great businesses trade at truly cheap prices. And that's when patient, disciplined investors can make life-changing returns. Now, let me be very clear about something. I'm not a perma bull. I'm not someone who says buy stocks no matter what. There are times when stocks are overvalued and you should be cautious. There are times when the smart move is to sit on cash and wait. But there are also times when fear has pushed prices so low relative to value that buying becomes almost a certainty for making money over time. And we're in one of those times right now. Let me tell you, what's creating the current panic and why it's creating opportunities. First, there's fear about recession. The economy has been slowing. Some economic indicators are weakening. Unemployment is ticking up slightly. Consumer confidence is declining. And economists are predicting that we might enter a recession in the next 6 to 12 months. This fear is causing investors to sell stocks because they assume that recessions are terrible for corporate profits. Second, there's fear about interest rates. Even though the Federal Reserve has started cutting rates, they were at elevated levels for a long time. This squeezed profit margins for many companies. It made borrowing more expensive. It slowed economic activity. Investors worry that the damage from high rates is still working its way through the system. Third, there's fear about geopolitical risk. There are conflicts around the world, trade tensions, political uncertainty. These create unpredictable environments that investors hate. When the future feels uncertain, people sell stocks and hide in cash or bonds. Fourth, and this is the big one, there's fear that the bull market of the past few years is over. We've had a great run. The market has gone up substantially from the lows of 2020. Some investors think we're due for a major correction or bear market. They're selling now to avoid bigger losses later. All of these fears have combined to create selling pressure. Stock prices have declined from their peaks. Some sectors are down 20 or 30%. And investors are scared. They're watching their wealth decline and they're wondering if it'll get worse. This is exactly the environment I love. Not because I enjoy seeing people suffer, but because fear creates mispricing. When everyone is focused on what could go wrong, they ignore what's actually happening in the businesses. They sell good companies at bad prices. They create opportunities for people who can keep their heads while others are losing theirs. Let me walk you through what I'm seeing right now and what I'm buying. I'm going to give you specific sectors and the types of companies I'm most interested in. And I'm going to explain the thought process behind each decision because that's more important than the specific stocks. If you understand how to think during a panic, you can apply that thinking to any situation. The first area where I'm deploying significant capital is financial services, specifically banks and insurance companies. Why financials? Because they've been absolutely crushed. The regional banking crisis of 2023 created lasting fear about the entire financial sector. Every time there's any economic weakness, investors assume banks will fail. Every time interest rates move, investors worry about banks' bond portfolios. This fear has driven bank stocks to valuations that are absurd. I'm seeing well-capitalized banks with strong deposit bases trading at 8 to 10 times earnings. Some are trading below tangible book value for businesses that typically earn 12 to 15% returns on equity in normal conditions. These valuations imply that investors think the banks will fail or that returns will collapse permanently. Neither is true. Let me tell you what I'm actually seeing when I look at the banking sector. I'm seeing banks that came through the regional banking crisis without a scratch. Their deposits remain stable. Their capital ratios remain strong. They continued earning profits. Yes, their profitability declined somewhat because they had to pay higher rates on deposits to retain them. But they adapted. They remained solid businesses. And now with interest rates coming back down, their profitability is improving. Lower rates mean they can pay less on deposits while still competing effectively. Their bond portfolios are recovering value as rates fall. And their loan portfolios are performing well with low default rates. These are not businesses in distress. These are solid, profitable, well-managed banks that happen to be trading at depression-era valuations because investors are scared. So I'm buying the highest quality regional banks with fortress balance sheets. I'm buying banks with diversified loan portfolios that aren't overexposed to any one sector. I'm buying banks with sticky deposits from small businesses and consumers. And I'm buying banks with smart management teams that have navigated past crises successfully. These banks will do more than survive. They'll thrive. And in 3 or 5 years, when the fear has passed and investors remember that banks are good businesses, these stocks will trade at 14 to 16 times earnings instead of 8 to 10 times. That's a double right there. Plus, I'm collecting 4 to 5% dividends while I wait. That's exactly the kind of risk reward I'm looking for. Now, let me talk about insurance companies because this is another area where I'm finding great value. Insurance is a business I know intimately. Berkshire Hathaway owns several insurance companies, including Geico. I understand the economics. I understand what creates value. And I'm seeing insurance companies trading at very attractive prices. Why? Because investors don't understand the insurance business. They see insurance as boring and cyclical. They worry about catastrophe losses from hurricanes or wildfires. They worry about investment losses when stock markets decline. But they miss what makes insurance such a wonderful business. Let me explain the core economics of insurance. An insurance company collects premiums from policyholders. They hold that money, which we call float, until they need to pay claims. In the meantime, they invest that float. If they're disciplined underwriters, the premiums they collect exceed the claims they pay out, plus their operating expenses. This creates an underwriting profit, and they also earn investment income on the float. So they're making money two ways, from underwriting profit and from investment income. Now, the beautiful thing about float is that it's not the insurance company's money. It belongs to policyholders who will eventually make claims, but the insurance company gets to invest it. If they invest wisely, they can generate substantial returns. At Berkshire, we have about $160 billion afloat. We invest that float in stocks and bonds. Over the years, this float has been better than free. Not only do we get to invest money that isn't ours, but our underwriting has been profitable, meaning policyholders have essentially paid us to hold their money. That's an incredible business model. But most investors don't appreciate this. They see insurance as a commodity business with thin margins and catastrophe risk. So insurance stocks trade cheaply. I'm buying property and casualty insurance companies that are disciplined underwriters. I'm buying companies that have consistently generated underwriting profits over many years. I'm buying companies with conservative investment portfolios that won't blow up when markets are volatile. And I'm buying companies that are trading at significant discounts to book value. These companies will compound value steadily over time. They'll generate underwriting profits. They'll earn investment income. They'll grow their float. And over a decade, they'll create substantial wealth for patient shareholders. But because they're boring and misunderstood, they trade cheaply. That's fine with me. I prefer to buy boring, misunderstood businesses at cheap prices rather than exciting, overhyped businesses at expensive prices. The second major area where I'm deploying capital is energy. I've already seen tremendous value in energy stocks, and the panic has made them even cheaper. Integrated oil companies are trading at 5 to 7 times earnings. 5 to 7 times. For businesses generating tens of billions of dollars in free cash flow. For businesses with decades of oil and gas reserves. For businesses returning massive amounts of cash to shareholders. Why so cheap? Because everyone is convinced that oil is dying. Electric vehicles are coming. Renewable energy is taking over. Oil demand will collapse. These companies are dinosaurs. But this narrative is wrong, completely wrong. Oil demand is not collapsing. It's still growing. Yes, eventually, decades from now, oil demand will peak and decline, but that's not happening anytime soon. In the meantime, the world needs enormous amounts of oil. And because the industry has underinvested in new production for years, supply is constrained, this supports prices. At current oil prices in the $75 to $85 range, the best oil companies are generating free cash flows that represent 12 to 15% of their market capitalization. That's extraordinary. They're using that cash to pay dividends of 4 to 6% and buy back stock aggressively. Over time, the combination of dividends, buybacks, and modest production growth will create excellent returns. But investors are ignoring this because they're focused on the narrative that oil is finished. This is classic panic thinking. They're so worried about what might happen 20 years from now that they're ignoring what's happening today. The businesses are minting cash. They're returning that cash to shareholders. And they're trading at absurdly low valuations. So I'm buying the integrated oil majors with low-cost production, strong balance, sheets, and disciplined capital allocation. I'm buying companies that are returning 50 to 70% of free cash flow to shareholders, and I'm holding for the long term. These stocks don't need oil prices to spike to generate great returns. They just need oil to stay in a reasonable range and for the companies to keep buying back stock at cheap valuations. over 5 or 10 years. This will create tremendous wealth. And when the panic passes, when investors realize that oil companies aren't going away, these stocks will rate higher. A company trading at 6 times earnings could easily trade at 10 or 11 times. That's a 60 to 80% gain plus the dividends. That's exactly what I'm looking for. The third area where I'm buying aggressively is healthcare. This sector has been hit hard by the panic for several reasons. There's political fear about drug pricing. There's concern about the post-COVID decline in healthcare utilization. There's worry about the impact of weight loss drugs on other areas of healthcare. All of this has created selling pressure and attractive valuations. I'm seeing pharmaceutical companies trading at 11 to 13 times earnings. Medical device companies trading at 14 to 17 times earnings. Healthcare services companies trading at single-digit multiples. These are quality businesses with durable competitive advantages trading at prices that reflect significant pessimism. Let me focus on pharmaceutical companies first, because this is where I'm seeing the most compelling opportunities. The narrative is that drug pricing will be crushed by government intervention, that new drugs won't be profitable because regulators will force prices down, that the golden age of pharma is over. But when I look at the actual businesses, I see something different. I see companies with multiple blockbuster drugs generating billions in revenue. I see strong pipelines of new drugs in development. I see businesses that are still highly profitable despite all the political pressure. Yes, some drug prices have come down. Yes, the regulatory environment is tougher. But these businesses are adapting. They're focusing on drugs that provide clear value. They're expanding internationally, where pricing is less constrained. And they're maintaining solid profit margins. More importantly, the fundamental drivers of pharmaceutical demand remain intact. The population is aging. Older people use more medications. The middle class is growing in developing countries. As people get wealthier, they spend more on healthcare. We're making scientific progress on diseases that were previously untreatable. All of this creates demand for new drugs. The best pharmaceutical companies will continue to develop blockbuster drugs. They'll continue to generate strong cash flows. They'll continue to pay dividends and buy back stock. But they're trading as if none of this will happen, as if they're in terminal decline. That's fear, that's panic, and that's opportunity. I'm buying large cap pharmaceutical companies with diversified portfolios, strong pipelines, and attractive valuations. I'm buying companies that have successfully navigated patent expirations in the past and will do so again. And I'm buying companies with strong balance sheets and high profit margins that can sustain themselves through any regulatory challenges. These companies will do just fine. And when the panic passes, when investors remember that pharmaceuticals is a good business with favorable demographics, these stocks will trade at 17 to 20 times earnings instead of 12. That's a 40 to 60% gain plus the dividends. For medical device companies, the opportunity is similar but less dramatic. These companies are trading at somewhat more reasonable valuations, but they're still cheap relative to their quality and growth prospects. Medical devices benefit from the same aging demographics as pharma. They benefit from technological innovation that makes procedures better and less invasive, and they have strong competitive positions with high switching costs. I'm particularly interested in companies that make orthopedic devices for joint replacements, cardiac devices like pacemakers and defibrillators, and surgical equipment and robotics. These are all areas with strong growth prospects and high barriers to entry. The companies are profitable. They're growing steadily, and they're trading at reasonable valuations that leave room for appreciation as the market recognizes their quality. I'm also interested in healthcare services companies that have been beaten down. Pharmacy benefit managers are trading at very low valuations because of political concerns about their role in drug pricing. Wholesale drug distributors are trading cheaply because they're seen as low margin, low growth businesses. But these companies provide essential services. They generate steady cash flows, and they're much cheaper than they should be. At current valuations, even modest growth creates good returns for shareholders. The fourth area where I'm deploying capital is in select consumer companies. Not all consumer stocks. I'm very selective here, but there are specific consumer businesses that have been caught in the panic selling that represent real value. I'm focused on consumer staple companies with strong brands, pricing power, and global reach. These are companies that sell products people use every day, regardless of the economy. Think food and beverage companies, household products, personal care products. The best of these companies have characteristics that make them exceptional long-term investments. First, they have brands that consumers love and trust, brands that have been built over decades, brands that command premium prices. Second, they have pricing power. When costs go up, they can raise prices without losing significant volume. This protects profit margins. Third, they generate high returns on capital. These aren't capital-intensive businesses. They don't need to build expensive factories or infrastructure. They can generate strong cash flows with modest capital requirements. Fourth, they have opportunities for growth, particularly in developing markets. As incomes rise in Asia, Africa, and Latin America, billions of people are entering the consumer class. They're buying branded products for the first time. This creates a long runway for growth. The best consumer staple companies check all these boxes, and some of them are trading at attractive valuations because of the general panic in the market. They're not as cheap as banks or energy companies, but for stable, high-quality businesses that will compound steadily for decades, they're reasonably priced. I'm buying food and beverage companies with iconic brands. I'm buying household products companies with wide distribution and strong market positions. And I'm buying personal care companies that are expanding successfully in emerging markets. These businesses might not double in the next year, but over 10 or 20 years, they'll generate strong returns through a combination of steady earnings growth, dividend increases, and share buybacks. And they'll do it with less volatility than most other stocks. That makes them attractive core holdings for any portfolio. Now, I also want to talk about what I'm not buying during this panic, because avoiding mistakes is just as important as finding opportunities. I'm not buying unprofitable technology companies, even though many of them have declined dramatically. Yes, some tech stocks are down 50 or 60% from their peaks, but many of them were overvalued to begin with. A stock that was worth $20 trading at $100 and then declining to $40 is still overvalued. It's not a bargain just because it's down 60%. I'm particularly cautious about companies that have never made a profit and might never make a profit. Companies that are burning cash. Companies whose business models depend on continued access to cheap capital. When capital was nearly free in 2020 and 2021, these companies could keep raising money. But now that capital is more expensive and investors are more discerning. Many of these companies will fail. I don't want to try to pick the winners from the losers in that group. I'd rather invest in businesses that are already profitable, that generate cash, that have proven business models. I'm also not buying commercial real estate, particularly office buildings. The office sector has been fundamentally changed by remote work. Occupancy rates are down, rents are down, property values are down. And I don't see this recovering to pre-COVID levels. Some office buildings will be repurposed or demolished. Some landlords will default on mortgages. This will be a long, painful process. There might be opportunities eventually to buy office properties at very distressed prices, but we're not there yet. Prices are down, but they haven't fully adjusted to the new reality of lower demand. So I'm staying away. I'm also being cautious about retail, except for the strongest retailers. E-commerce continues to take share from physical retail. Malls are dying. Many retail chains are struggling. Yes, some retail stocks are down significantly, but that doesn't make them good investments if the underlying business is in structural decline. Now let me talk about the psychology of buying during a panic, because this is crucial. It's one thing to understand intellectually that panics create opportunities. It's another thing entirely to actually deploy capital when everyone around you is selling and telling you you're crazy. I've been through this many times, and I can tell you that it never gets easy. Every time there's a panic, there are compelling reasons to be scared. Smart people can give you very convincing arguments for why this time is different, why the problems are insurmountable, why things will get worse before they get better. And those arguments might even be partially true. But here's what I've learned. The time to buy is when there's blood in the streets, when everyone is scared, when selling pressure has pushed prices well below intrinsic value, because that's when you get the best prices. And over the long term, price is what matters. If you buy a good business at a great price, you'll make money even if things get worse before they get better. Let me give you a framework for how to think about buying during panics. First, separate the business from the stock price. The stock price is going down. That's scary. But what's happening to the actual business? Is it still generating cash? Are customers still buying its products? Is the competitive position intact? If the business fundamentals are solid, the declining stock prices is an opportunity, not a threat. Second, focus on 3 to 5 year outcomes, not 3 to 6 month outcomes. Yes, things might get worse over the next few months. The economy might weaken further. Stock prices might decline more. But where will this business be 3 years from now, 5 years from now? If you believe it will be stronger and more valuable, then buying today at panic prices will work out well, even if there's more pain in the short term. Third, ask yourself what would have to happen for you to lose money permanently, not for the stock to go down temporarily, but for you to suffer a permanent loss of capital. Usually, this requires the company to go bankrupt or to suffer catastrophic competitive losses. If you're buying high-quality businesses with strong balance sheets and durable competitive advantages, the probability of permanent loss is low. Most of the risk is temporary volatility, which doesn't matter if you're patient. Fourth, size your positions appropriately. Don't bet everything on one stock. Diversify across multiple high-quality businesses. This way, if you're wrong about one specific company, it doesn't devastate your portfolio, but you still benefit when most of your holdings work out. Fifth, be prepared for more volatility. Just because you buy today doesn't mean stocks go straight up from here. They might go down further. That's okay. If your thesis is correct, the eventual outcome is what matters. Use further declines as opportunities to buy more at even better prices. Let me share a specific example of how I applied this thinking. In March of 2020, when COVID hit and the market crashed, I bought airline stocks. This turned out to be a mistake. I sold them a few months later at a loss. Why was it a mistake? Because I violated my own principles. I bought businesses that were fundamentally changed by COVID. Air travel demand collapsed. Airlines were burning billions in cash. The competitive dynamics of the industry had shifted. I should have recognized that the business was impaired, not just the stock price, but I also made many successful investments during that panic. We bought stock in our existing holdings. We bought more. Chevron. We invested in several Japanese trading companies. These investments worked out extremely well because the businesses were fundamentally sound. The panic had created temporary mispricing, but the underlying businesses remained strong. The lesson is that even I make mistakes during panics, but the framework still works. If you focus on business quality, if you buy when there's fear, if you're patient, you'll do well much more often than you fail. Now let me talk about position sizing and portfolio construction during a panic. How much should you invest? How should you allocate across different opportunities? This depends on your specific situation, your age, your risk tolerance, your need for income. But let me give you some general guidelines. If you're younger with a long time horizon, you can be more aggressive. You have time to recover from mistakes. You have decades for your investments to compound. I'd suggest putting significant capital to work during a panic, maybe 60 to 80% of available capital deployed fairly quickly. If you're older or closer to retirement, be more cautious. You have less time to recover from mistakes. You might need to access this capital sooner. I'd suggest deploying maybe 30 to 50% of available capital, keeping the rest in cash or short-term bonds for safety. In terms of allocation across sectors, I'd diversify. Don't put everything in banks or everything in energy. Spread your capital across multiple sectors and multiple companies within each sector. My current thinking is roughly 35% in financial services, 30% in energy, 25% in healthcare, and 10% in consumer staples. But that's just a rough guideline. Your specific allocation should depend on your own analysis and conviction. Within each sector, own 3 to 5 companies. This gives you diversification but maintains concentration in your best ideas. I'm also implementing this systematically over time, not all at once. I'm buying now, but I'm keeping some dry powder for further declines. Maybe I deploy 60% of my capital now and reserve 40% in case things get worse. This way, I'm taking advantage of current prices, but I'm also positioned to benefit if the panic intensifies. Now, let me address some common objections I hear when I tell people to buy during panics. First objection is, what if things get worse? What if we're heading into a severe recession? What if stock prices fall another 20 or 30%? My answer is, so what? If you're investing for 3 to 5 years or longer, it doesn't matter if stocks go down more in the short term. What matters is where they end up 3 to 5 years from now. And based on history, buying quality businesses at reasonable prices during panics has worked out well over those time frames. Second objection is, what if this time is different? What if the problems facing the economy are worse than past recessions? My answer is that every panic feels like this time is different. In 2008, people thought the financial system was collapsing and we'd have another Great Depression. In 2002, people thought the tech bubble bursting would destroy the economy. In 1987, people thought Black Monday signaled a new era of market instability. Every time felt different. Every time felt worse than before. And every time the panic proved to be temporary. The economy recovered, businesses adapted, stock prices came back. I'm not saying that economic problems aren't real, they are. But markets overreact to bad news just as they overreact to good news. And that overreaction creates opportunity. Third objection is, I'll wait for confirmation that things are getting better before I buy. It sounds logical, but it's exactly wrong. By the time you have confirmation that things are improving, stock prices will have already recovered significantly. You'll have missed the best buying opportunities. The whole point of buying during a panic is that you're buying before things improve, before the crowd recognizes that the problems are temporary, before prices adjust back to fair value. If you wait for confirmation, you'll pay much higher prices. Fourth objection is, I don't have cash available to invest right now. That's a real constraint, and I understand it. But if you don't have cash now, make sure you build up cash reserves during the next good period so that you're ready for the next panic. One of the reasons I'm able to buy aggressively during panics is that I maintain large cash reserves during normal times. When everyone else is fully invested and complacent, I'm holding cash and waiting. This cash position might underperform during bull markets, but it gives me the ammunition to buy aggressively when opportunities appear. That's a trade-off I'm willing to make. Now, let me talk about the timeline for these investments. When will the panic end? When will stock prices recover? I have no idea. Nobody does. It could be 3 months. It could be a year. It could be longer. That's why you need to be patient and focus on the fundamentals rather than trying to time the bottom. What I can tell you is that panics always end. Always. The economy doesn't collapse. The financial system doesn't disappear. Life goes on. Businesses adapt. And eventually, investors realize they overreacted. They start buying again. Prices recover. The cycle continues. How long does this take? Based on history, most market panics are relatively short-lived. The average bear market lasts about a year. Some are shorter, some are longer. But within a year or two markets typically recover their losses and move to new highs. This doesn't mean your specific stocks will recover that quickly. Some might take longer if the business has real problems. But if you're buying quality businesses at good prices, the odds are strongly in your favor that you'll be showing solid gains within 3 to 5 years. Let me close with this thought. I've been investing for over 80 years. I've lived through more market panics than I can count. The 1957 recession, the 1962 market crash, the 1973 to 74 bear market, the 1987 crash, the 1998 Russia and long-term capital crisis, the 2000 to 2002 tech bubble bursting, the 2008 financial crisis, the 2020 COVID crash, and many others. Every single time there were convincing reasons to be scared. Every single time smart people predicted disaster. Every single time it felt like this time was different. And every single time the panic proved temporary. The best investment decisions I made in my career were buying during those panics. Buying Geico in 1951 when the insurance industry was out of favor. Buying Coca-Cola in 1988 after the stock market crash. Buying during the financial crisis in 2008 and 2009. These investments made billions for Berkshire Hathaway because I was buying what others were selling. I was being greedy when others were fearful. That's the secret. It's not complicated, but it requires courage, discipline, and patience. Right now, we're in another panic. People are scared. They're selling. And I'm buying. I'm buying banks. I'm buying energy companies. I'm buying healthcare companies. I'm buying select consumer companies. I'm deploying capital aggressively into quality businesses at attractive prices. 5 years from now, these investments will look brilliant. Not because I'm smarter than everyone else, but because I'm doing what always works. Buying good businesses when everyone else is panicking. If you have capital available, if you have the courage to act, if you can ignore the fear and focus on the fundamentals, this is your opportunity. Don't waste it. Don't let fear paralyze you. Don't wait for confirmation that things are improving. Buy now while everyone else is panicking. Build positions in quality businesses. Be patient and let time and compounding work in your favor. That's what I'm doing. That's what's worked for 8 decades. And that's what will work for you if you have the discipline to execute it. But let me give you much more specific detail about exactly how I'm evaluating these opportunities and how you can do the same. Let me start by walking you through a specific bank that I find attractive. I won't name it because I don't want to move the market, but I'll describe it in detail so you can identify similar opportunities. This is a regional bank headquartered in the Southeast with about $80 billion in assets. They operate in growing markets: Florida, Georgia, the Carolinas. These are states with positive population migration. People are moving there from high-tax states. Businesses are relocating there. This creates natural demand for banking services. Now, look at their loan portfolio. About 30% commercial and industrial loans. These are loans to businesses for working capital and equipment. About 30% residential mortgages. These are mostly prime borrowers with good credit and substantial down payments. About 25% commercial real estate, but it's well diversified across retail, industrial, multifamily. They're not concentrated in office buildings. About 15% consumer loans, auto loans, home equity lines, credit cards. This is a well-diversified loan book. No dangerous concentrations. Conservative underwriting standards with average loan-to-value ratios under 70%. What about their deposit base? About 70% of deposits are under the FDIC insurance limit of $250,000. These are fully insured and sticky. The deposits come from small businesses and middle-class consumers who need checking accounts to run their lives. These aren't hot money deposits from venture capital firms or hedge funds that will flee at the first sign of trouble. Their capital ratios are strong. Common equity Tier 1 capital of 13%. That's well above regulatory requirements and provides a substantial cushion to absorb any loan losses. Their bond portfolio has unrealized losses, but those losses are manageable relative to their capital. And the duration is reasonable, about 5 years. So as rates stabilize or fall, those unrealized losses will diminish. Most importantly, they have ample liquidity. They're not forced sellers of bonds. They can hold to maturity. Now, what's this bank earning? Over the past year, they earned about $3.20 per share. The stock is trading at about $30. That's 9.3 times earnings. And they're paying a dividend of about 4.5%. 9 times earnings for a well-run bank in growing markets with a fortress balance sheet and conservative underwriting. That's absurdly cheap. Why so cheap? Fear. Investors are scared of regional banks because of what happened in 2023. They're scared of recession causing loan losses. They're scared of more banks failing. But this specific bank is nothing like Silicon Valley Bank or First Republic. The business model is completely different. The deposit base is completely different. The risk profile is completely different. Yet it trades as if it might fail tomorrow. What's the opportunity? This bank will earn about $3.50 per share this year as margins stabilize. If it traded at 13 times earnings, which is still below pre-crisis averages, the stock would be worth $45. That's 50% upside from $30. Add in the dividend, and you're looking at returns of 10 to 15% per year for 3 to 5 years. That's attractive. And the downside is limited because you're buying at such a cheap valuation. Even if earnings decline somewhat in a recession, at 9 times earnings, you're protected. The stock doesn't have far to fall. This is the type of analysis I'm doing for each bank I'm considering. I'm studying the loan portfolio. I'm studying the deposit base. I'm studying the balance sheet. I'm studying the management team and their track record. And when I find banks that meet my criteria, I'm buying. Now, let me give you a similar detail on an energy company. Again, I won't name it specifically, but I can describe it. This is an integrated oil company with operations in North America, Europe, and Asia. They produce about 2.5 million barrels of oil equivalent per day. That's a mix of crude oil and natural gas. They also have downstream refining and chemical operations that process about 2 million barrels per day. What's their cost structure? Their upstream production costs are about $35 per barrel all in. That includes finding costs, development costs, lifting costs, and overhead. These are low costs. They can make money at $50 oil. Above that, Incremental production is highly profitable.
At current oil prices of around $80 per barrel, their upstream business is generating enormous cash flow, about $30 billion per year in operating cash flow from the upstream operations alone.
The downstream refining business is more cyclical, but it's currently generating about $10 billion per year in operating cash flow because refining margins have been good. So total operating cash flow is about $40 billion. They spend about $15 billion on capital expenditures to maintain production and grow modestly. That leaves $25 billion in free cash flow. What are they doing with that $25 billion? Paying a dividend of $12 billion, buying back stock worth $10 billion, and reducing debt or building cash with $3 billion. The dividend yield is about 4.8%. The buyback yield is about 4%. Combined, they're returning almost 9% of their market cap to shareholders annually. And they're doing this while maintaining production, investing in the business, and strengthening the balance sheet. The company's market cap is about $250 billion. They're generating $25 billion in free cash flow. That's a 10% free cash flow yield. 10%. For a business that's essential to the global economy, that has decades of reserves, that's buying back stock aggressively at cheap prices. Why so cheap? Because investors think oil is dying. They think electric vehicles will destroy oil demand. They think the world will move to renewables rapidly. But the data doesn't support this. Oil demand is still growing and will likely keep growing through the end of this decade at minimum. This is why I'm so bullish on energy. The math is compelling. The valuations are absurd. And the fear creating those valuations is overblown. Now let me share some lessons I've learned about buying during panics over 8 decades that go deeper than most investors realize. These are the insights that separate successful panic buyers from those who lose money even when they think they're buying value. First lesson is about distinguishing between price and value during panics. This sounds simple, but it's where most investors fail. When a stock drops 30 or 40%, they assume it's cheap. But cheap relative to what? If a stock was worth $50 and it drops to $30, that's a bargain. But if a stock was worth $30 and it drops to $30 after being overvalued at $50, that's not a bargain. It's just fair value. During panics, you need to do the fundamental work of estimating intrinsic value. What are the normalized earnings? What return on capital can this business sustain? What growth rate is reasonable? What multiple is appropriate given these characteristics? Only after you've done this work can you determine if the current price represents genuine value. I see too many investors who skip this step. They see a stock down 40% and assume it's a buy. But sometimes stocks are down 40% because they were overvalued by 60%. You're not buying value in that case. You're just buying something less overvalued. My discipline is to only buy when I can estimate intrinsic value with reasonable confidence and when the current price is at least 30 to 40% below that estimate. This margin of safety protects me if my analysis is somewhat wrong. Second lesson is about understanding business quality during stress. Here's something counterintuitive. You learn more about a business during bad times than during good times. When the economy is booming and credit is easy, even mediocre businesses can appear successful. But during panics and recessions, the quality differences become obvious. The best businesses maintain pricing power. They protect margins. They generate cash even in tough times. Mediocre businesses see their margins collapse. They burn cash. They struggle to survive. This is why I pay close attention to how businesses perform during crises. The financial crisis of 2008 taught me a lot about which businesses had real competitive advantages and which just looked good during the boom. The banks with the strongest deposit franchises, the ones with conservative underwriting, they came through fine. The banks that had grown aggressively by taking risks, they failed or nearly failed. Same industry, totally different outcomes based on business quality. So when I'm buying during a panic, I'm not just looking at current valuations. I'm studying how the business is performing under stress. Is it gaining market share while competitors struggle? Is it maintaining margins? Is it generating cash? These are signs of a truly high quality business that will emerge from the crisis stronger. Third lesson is about the importance of balance sheet strength. I cannot overemphasize this. During panics, liquidity dries up. Credit becomes expensive or unavailable. Companies with weak balance sheets get into trouble no matter how good their business models might be. They can't refinance maturing debt. They can't fund operations. They're forced into distressed sales or bankruptcy. Companies with strong balance sheets, lots of cash, and manageable debt levels, they not only survive, they thrive. They can invest in growth while competitors are retrenching. They can acquire distressed assets cheaply. They emerge from the crisis with stronger competitive positions. This is why before I buy anything during a panic, I scrutinize the balance sheet. How much cash do they have? What are their debt maturities? Can they service their debt even if revenues decline? Do they have access to credit lines? If I have any doubt about financial strength, I pass. There are enough strong companies available at good prices that I don't need to take balance sheet risk. Fourth lesson is about management quality and capital allocation. During panics, management teams reveal their true character. Some managements panic along with the market. They cut spending indiscriminately. They hoard cash out of fear. They make defensive moves that weaken the business long term. Other managements stay calm and strategic. They maintain investment in the business. They take advantage of opportunities. They make moves that strengthen their competitive position. These differences in management response create massive differences in outcomes. When I'm evaluating companies during panics, I look at what management is saying and doing. Are they confident or scared? Are they investing or retrenching? Are they buying back stock at these low prices or suspending buybacks? Are they acquiring assets or selling assets? The best managements are opportunistic during panics. They recognize that fear has created opportunities and they act accordingly. Those are the managements I want to partner with. Fifth lesson is about sector rotation and where opportunity concentrates.
Not all sectors get hit equally during panics, and not all sectors recover equally. Understanding these patterns helps you focus your buying where opportunities are greatest.
Typically, cyclical sectors get hit hardest during panics. Financials, industrials, materials, energy. These sectors are perceived as most vulnerable to economic weakness, so they sell off most aggressively. Defensive sectors like healthcare and consumer staples hold up better. This creates opportunity in the cyclical sectors because the sell-off often exceeds what's justified by fundamentals. But you have to be selective within cyclicals. Some cyclical businesses are truly impaired by recessions. Their earnings collapse. They burn cash. Others are more resilient. They remain profitable even in downturns. Their cash generation slows but doesn't stop. These differences matter enormously. I focus on the high-quality cyclicals that get sold off along with the weak ones. The strong banks that get lumped in with weak banks. The low-cost energy producers that get sold along with marginal producers. These represent the best opportunities because fear has created indiscriminate selling. Sixth lesson is about understanding market psychology and where we are in the panic cycle. Panics go through stages. There's an initial decline when bad news emerges. Then there's usually a bounce as bargain hunters step in. Then there's a retest of the lows or new lows as the bad news continues. Then capitulation when the last investors give up. And finally, recovery when it becomes obvious the worst is over. The best buying opportunity is usually during capitulation. That's when fear is most extreme. That's when selling is most indiscriminate. That's when you can buy the highest quality businesses at the lowest prices. But capitulation is also the scariest time. Everything looks terrible. The news is awful. Everyone is bearish. It takes courage to buy then. How do you know when we're in capitulation? A few signs. Volatility spikes to extreme levels. Volume surges as everyone tries to sell. Sentiment measures show extreme pessimism. Put-call ratios show everyone buying puts for protection. Credit spreads blow out. These are all signs that fear has reached a peak. When I see these signals, I know we're close to maximum opportunity. Seventh lesson is about the importance of acting decisively once you've done your analysis. One of the biggest mistakes I see investors make is endless deliberation. They research, they analyze, They wait for more information. They want perfect clarity before they commit capital. But by the time you have perfect clarity, the opportunity is gone. Prices have recovered. You've missed it. The nature of buying during panics is that you have to act with incomplete information. You have to make decisions when things are uncertain. You have to commit capital when you're not totally comfortable. This requires decisiveness. Once you've done your analysis, once you've identified good businesses at attractive prices, you need to act. Don't wait for the perfect moment. Don't overthink it. Buy and move on. I've made this mistake myself. During the financial crisis, I identified several opportunities early, but I hesitated on some of them. I wanted to see more evidence that things were stabilizing. And by the time I felt comfortable, prices had recovered significantly. I still made good returns, but not as good as if I'd acted more decisively at the beginning. The lesson is that buying during panics requires both analysis and action. Do the analysis to identify opportunities, then act decisively to capture them. Eighth lesson is about position sizing and scaling in. I mentioned this earlier, but it's worth expanding on. When you're buying during a panic, you don't need to deploy all your capital at once. In fact, it's usually better to scale in over time. Here's my approach. I identify a target position size based on my conviction. Let's say I want to own 5% of my portfolio in a particular bank stock. I'll buy maybe 2% immediately. Then I'll watch how things develop. If the stock drops further and my thesis is still intact, I'll buy more. I'll add another 1 or 2%. If it keeps dropping, I'll add the final portion. This way, I'm averaging into the position. I'm getting some shares at higher prices and some at lower prices. Over time, I end up with a good average cost. This approach also gives me flexibility. If my thesis starts to look wrong, if I learn information that changes my view, I can stop adding. I'm not all in on a position that's not working. I have room to adjust. The key is having a plan before you start buying. Know your target position size. Know at what prices you'll add. Know what would cause you to stop adding or exit the position. Then execute the plan systematically. Ninth lesson is about the power of focusing on absolute returns rather than relative returns. During panics, most investors are focused on relative performance. They're trying not to lose as much as the market. They're trying to beat their benchmark. This mindset is a mistake. When everything is falling, who cares if you're falling less than the market? You're still losing money. I focus on absolute returns. I want to make money over time, period. Not lose less than others, not beat a benchmark, actually make money. This mindset changes how I invest during panics. I don't try to stay fully invested just to track the market. If I can't find enough good opportunities, I hold cash. Cash doesn't lose value during panics. It's stable. And it's available to deploy when better opportunities appear. I'd rather hold 30% cash and have my invested capital in truly attractive opportunities than be 100% invested in mediocre opportunities just to stay fully invested. This focus on absolute returns also affects my risk management. I'm not willing to take big risks just to try to keep up with the market during rallies. I'd rather preserve capital during declines and deploy it strategically when opportunities appear. 10th lesson is about learning from every panic. Each panic is unique. Each teaches you something new about markets, about businesses, about yourself. I try to extract lessons from every crisis I lived through. What worked, what didn't work, what would I do differently? These lessons compound over time. The more panics you experience, the better you get at navigating them. After the financial crisis, I learned that I should have been more aggressive buying financials. The banks that survived became incredible investments. But I was too cautious early on. That lesson influenced how I approached the COVID crash. I was more decisive, more willing to act quickly. After the COVID crash, I learned that some business models are more vulnerable to disruption than I'd appreciated. Airlines and hotels suffered severe impairment. That lesson is influencing how I think about businesses today. This continuous learning is crucial. Markets evolve, economies change, new risks emerge. You have to keep learning and adapting. The investors who succeed over very long periods are the ones who learn from experience and improve their process continuously. Let me close with one final crucial point about buying during panics. This is perhaps the most important thing I can tell you. The reason most investors fail to profit from panics is not lack of knowledge or analytical skill. It's lack of emotional control. They know intellectually that panics create opportunities. They understand that buying low and selling high is how you make money. But when the panic is actually happening, when they're watching their portfolio decline, when the news is terrible, when everyone around them is scared, they can't pull the trigger. Fear overwhelms reason. This emotional challenge is why I've emphasized throughout this discussion the importance of preparation. You need to do your analysis before the panic intensifies. You need to identify the businesses you want to own and at what prices. You need to have a plan, because when fear is at its peak, you won't be able to think clearly. You'll be tempted to join the crowd and sell. But if you have a plan, if you've done the work in advance, you can execute mechanically. You don't need to think in the moment. You just follow your plan. This is what I do. I maintain a watch list of businesses I'd like to own at the right prices. When panics occur and those prices appear, I don't need to do new analysis. I've already done it. I just execute. This preparation is the key to successful panic buying. Do the work in advance, have a plan, then when the moment comes, execute with discipline. Your emotions will tell you to wait, to be cautious, to protect what you have. But your plan will tell you to buy. Follow the plan. This ability to act when others are paralyzed by fear is what separates successful investors from unsuccessful ones. It's not intelligence. It's not access to information. It's emotional discipline. If you can master that, if you can train yourself to be greedy when others are fearful, you'll build extraordinary wealth over time. That's what I've done. That's what I'm doing right now. And that's what you can do if you're willing to develop the discipline and courage required.